Well, the title, ladies and gentlemen, of our discussion is Monetary Tightening and Market Volatility, Managing Your Portfolio. I think we know there are immense challenges, and this was wonderfully outlined by Dr. Rabini early on. We are faced with an extraordinary context. The problem is, of course, as people actively involved in asset management, we have to make decisions right now. Thank you very much, Abdulmohsin, for that introduction. I think that set a wonderful context for our discussion. Rishi, could I please turn to you first? You're co-CEO of Investcorp Holdings. I think it's a legendary institution in the Gulf. You have pioneered private equity for many years. Could you tell us a little bit about your current strategies, and indeed if you're changing them at all in the light of present circumstances?
Sure. Before I do that, though, because I've walked a mile in people's shoes over there, can I just get a show of hands at the back? Can you hear me? Okay, that's good to know. Well, it's great to be in this room. I must admit, this is the year of the revenge of the conference, I think, because of the last 2-3 years that we weren't able to meet in the way that we had gotten used to meeting earlier before the pandemic. And this probably feels like the fullest room that at least I've experienced over the course of the last few months on the conference circuit, so to speak. Going back to your question, David, you're right. We do have a rather unique perspective at Investcorp now, given that we have a truly global footprint with 43 billion in total assets that we manage across all the key markets in US, Europe, Middle East, Asia, and across all the key asset classes that make up the broader space of private markets, including private equity, real estate, credit, infrastructure, and other liquid alts strategies. Abdulmohsin referred to one key ingredient that is very different in the modern context, in the present context rather, starts with an I, inflation. There's another one that also starts with an I, interest rates. A lot of the current investing paradigms, both within private markets and in public markets, have been driven by our experience over the course of the last 12, 13 odd years, where both were extraordinarily low. Not just low, extraordinarily low, right? So the regime change that we are facing, and of course it's interconnected, is one of high inflation and high interest rates as a consequence because of the drive by the central banks to counter the effects of runaway inflation. In that regime, if you do a little bit of a deeper dive into private markets, you actually can see exactly what it is about private markets that make them attractive in the first instance. The previous panel, John Rutledge, right towards the end of the discussion, he mentioned that he prefers private markets and private equity in particular as a better proxy for equity investing in general. And the reason for that is very simple, right? Private equity is the best way for the micro to trump the macro.
Yes.
Right.
Yes.
That's about the only opportunity you have to be able to not avoid the macro, because everyone is exposed to the macro considerations, the trends and the risks, but to be able to overcome those. And in the private equity context in particular, investing in sectors where there is a secular growth trend, right, or companies in sectors that are in those spaces, but also companies that have a clear market leadership position, and as a consequence, that massive ingredient for long-term success, which is pricing power, right? Mm-hmm. If you've got consumer demand, whether it's a business or the end consumer, but more importantly, if you have pricing power, guess what? You can actually overcome the effects of inflation. Same thing with real estate and infrastructure. They are both similar in one sense. They are both inflation indexed.
Yes.
Right? It's about the best hedge, particularly in real estate. If you are investing in assets that have a component of yield, and so lower duration, and have shorter lease rollovers. in a growing market though, right? Investing in downtown office space in San Francisco is not a growth market right now. But if you're investing in multifamily, which is a growth market, where the lease rollovers are annual, or student housing, for instance, where the lease rollover is even shorter than annual, well, guess what? You are going to get automatically inflation indexed, and you will outperform the cost of debt service as well as rising prices. Same thing with private credit, the third major pillar of private markets. Most, if not all, private credit is floating rate.
Right.
Floating rates went from 0 to likely 4 or 5% over the course of the next several months. That's a 400 to 500 basis point absolute uplift in the expected return from that asset class, right? In an otherwise tough, uncertain macro environment. So our strategies, going full circle back to your question, David, are very, very simple. Pursue private equity investments in sectors where there are secular growth tailwinds, healthcare, business services, IT-enabled services. Pursue real estate investments in sectors where there is relatively short lease rollover terms and ongoing yield, and growing private credit.
Thank you very much indeed. I wanted to try and drill down on 1-2 specific asset categories in a moment. Could I turn to you, please, Yazan Abdeen? You're CEO of Abu Dhabi Investment Management. You characterize ADIM as a Middle East asset management company, and you also, interestingly, emphasize sustainable solutions. Could you tell us a little bit more about your business at ADIM, and particularly how you're adjusting to the new normal we're in?
Right. Thank you, David. So it's very interesting to be in a conference and hear that maybe for the first time in my career, for the past 20 years, I've been promoting investing in this part of the world as a portfolio manager, as an analyst, looking at businesses and markets getting created, going through booms and busts. But I wouldn't have imagined that I would hear Dr. Rabini say that the world is going into turbulence and turmoil, and he's finding stability in this part of the world. This is, I think, a real delta change to how we are positioned, whether we are building cities into the future like Saudi, or hosting the World Cup in Qatar, or having multiple financial centers in the UAE that secure stability and safety. I think this change specifically is the foundation on what we have built our firm to be. So we are a group of investors that have spent our careers investing in Middle Eastern equities, from Morocco to Oman. And we have witnessed over the past 20 years the changes that has taken place economically at a macro level and at a micro level. But there has always been a critical point in this idea of investing in the Middle East. And it is the outset of any discussion related to investing in this part of the world, where you would have a binary way of thinking. Are you a believer of oil prices or not? Are you a believer of geopolitical risk or not? Are you a believer of visions, transformation or not? And that usually renders any conversation with any investor at the outset of it, at best, at a 50% chance. However, there is more into this region about this, in our opinion, and this is what we did in 2019. We created a firm in partnership with the Sovereign Wealth Fund in the UAE that is based on the stability, governance, and robustness of a sovereign wealth fund, married with a group of investment professionals that have spent their lives investing in this part of the world, to create what we called a value-based investment solution about Middle Eastern investments across our own conviction risk. So what we have provided to the market is what Abdulmohsin said, the future of lower fees investing in form of solutions of smart beta investing in this part of the world. And that is the lowest end of our conviction risk spectrum. The highest end of the conviction risk spectrum, we launched a strategy in 2019 that aims to solve the initial binary question. So whether you're a believer or not, we believe that you can extract returns from this part of the world, as we have discussed it, based on market neutrality. So we do not make bets on oil, we do not make bets on views of real estate, on interest rate, on inflation, which are the big questions that the world is facing right now. And naturally, as investors, you're always asked to answer these questions. We choose not to answer these questions and just base our investment theme in our highest end conviction investment solution on paired trades, on ideas that a certain company, regardless what happens to the environment around it or the beta around it, it's going to outperform another business. We long a company, we short another company. This is the base of that investment solution. We think the capital markets are evolving to create futures markets and derivatives markets, which is going to enable us even to execute that on a cheaper level. But today, as these markets in Saudi and in Abu Dhabi are creating their futures and derivatives markets, we stand to say that we have been doing this for the past 3 years. So
thank you.
This is what we've been doing.
Very interesting. Abdulmohsin, could I ask you a question of you? I think by definition, in a family office, a lot of your clients have different objectives, one way or another. You've mentioned the 2 R's. That was a very interesting comment, and you've outlined a little bit about your approach. Have you changed, in fact, your strategic or your tactical allocations in the light of the really dramatic events we're passing through at the moment?
Yeah, I think people, can you hear me at the back? I just want to double. Okay, thank you. So I think people always think of the issues after the fact. I think the role of a wealth manager is to think about these issues before they happen. So we've been very, very cash centered. From 2011, different interviews have stated that watch out, buckle up, markets are going to correct. This has been on the public TVs. And that's the role, I believe, of a true wealth manager rather than a placement power. There is tons of placement agencies in this region that sells deal after deal, but very few of them are truly wealth managers that protects client money. We follow a very standard methodology of asset allocation based on client needs of liquidity, needs of risk or risk appetite, etc. This has been digitized. Even this has been digitized, and now in 10 minutes, you can get the full proposal. You can try this on our website. And for those of you who have Saudi accounts or Saudi IBSHR, you can even do all the KYC. And very soon, we'll have the same thing in the UAE. You can do the same thing as well in our Swiss entity. So standardizing and making sure the clients get the same process, the same deals, but not standardizing the asset allocation. The asset allocation has to be personalized. The investment objective is actually personalized.
Right.
Yes, from time to time, we look at what are the future 18 months look like, where do we want to overweight, where do we underweight, and we rely heavily on our big partners that will also help us to get access to a very unique transactions. Cobank, which is the equivalent of Amazon in South Korea, is a deal that we have exited 6 times the money last year. We are investors, or our client investors in TikTok. So those are technology companies that our clients are benefiting from on the long run, but we are not going to go and cherry pick which deal. We rely on the big successful managers that have that capability and piggyback with them and focus on our end on the asset allocation and providing not only asset allocation, but also access. That's what we call the AAA.
And your strategic allocations are reasonably fixed, are they, or have you made significant adjustments in terms of recent events?
No, we have moved away from private equity to private markets about 12 months ago, and we continue to do that. We have moved away from equity to preferred in the preparation for this market downturn. So we do move away. We believe that very soon we will be going more into the liquid side because that's an area which is finally giving us a better returns than what it has been historically. We've been moving away from real estate. We've been sellers since 2013 of real estate. Look at where real estate A lot of people sold a lot of real estate in the last 5 years. Good luck to the investors if they get 50% of their money. You have three things that happen against real estate. Occupancy rate are declining, cap rates is widening, and refinancing of the current debt is increased from, as we had, from 1% to 5%. So in a leveraged transaction, which most of the transactions we've seen are being marketed in this region of 60, 70%, there is no way an investor would get their equity back.
Right.
This is very important. The right R, not the wrong R, which I've stated earlier.
Right. Yazan, could I perhaps just go back to you for a moment? I'd like to look at 1, 2 asset classes. I mean, it's very easy to say you shouldn't be in equities right now because the situation is so dramatically against. Are we in perhaps a sweet spot in equities? This is a low moment. And could you perhaps also focus your discussion on local equities here that I think would be of great
Private or public?
To the audience?
Private or public equities?
Public.
So, see, this is an interesting conversation I've been hearing, and now you have alluded to, which is the difference between public and private markets generally. Now, academically, as investors, they are technically subject to similar, I would say, at least macro drivers. Yes, you have more control when it comes to private investments. You have benefits of, as was said, access to information, but at the same time, you have less pressure when it comes to dealing with public markets disclosures and the way market reacts to your results and to your strategic movements. However, there is another advantage realistically for asset managers is that you don't need to mark to market on daily basis, and this is a life that we have to live in public markets. That at the end of each day we issue a balance sheet on what has happened within this day. Now the trick is how to shift your mindset from being such short-term oriented in the way you think and to be able to incorporate the themes that have been discussed at a global level and how the world is going from single polarity to anti-globalization or tribalism, as was mentioned. When you apply this to equity, for sure, inflation and the increase of the risk-free rate definitely increases the discount on equities. That puts pressure on performance of global equities. And as the previous slide mentioned, MSCI World is down 20% now. So being less than this is generally a good thing. Maybe for a split second of history in the past 20 years, our region is actually positive year to date. So whether you believe this is driven by oil prices, by reforms, by visions, by transformation, but the reality is, as the world today is going through inflation, food insecurity, war, currency instability, this region is delivering net positive returns to investors. And I think there is something that is very important for us to be cognitive of. I lived this in 2008, where there was a delay of around 5-6 months from the global financial crisis hitting this part of the world. And we were saying that we're immune, we are US dollar-dominated economies, oil prices are gonna save us going through the financial crisis. Now, 6 months down the road, that totally disappeared. So I still believe that global correlation exists, and our markets need to act in tandem. In a global financial crisis, all asset classes go to correlation go to 1. This is a reality that we have to live within. However, how do we model for solving these issues? Yes, equities are a structural solution of any portfolio. They provide liquidity, they provide growth. On the long run, they should grow higher than, you should get more returns in equities than fixed income. So the question that is related to the right R, as Abdulmohsin mentioned, is risk. People think it's return. We believe in, as a hedge fund manager, we believe it is the relationship between both. How much risk are you paying for every unit of return that you require? So equities, in our opinion, do provide solutions for this. In a derivatives context, in futures context, You can solve for a portfolio that can generate for you capital guarantees while giving you an upside of a certain equity index. If you can find that optimal balance, then you can weather through, in our opinion, a global storm of volatility.
Thank you. I am going to ask for a few questions, which I hope we can have in a minute, just to sow that seed. But meanwhile, Rishi, as far as private equity is concerned, I mean, that's obviously been a quite successful strategy, given the tribulations of some other asset classes. Firstly, are you getting more potential customers coming to you and asking about private equity at the moment? How do you see that sort of relationship of private equity within a balanced portfolio?
So I'll tell you what actually has been our experience on that front. And we have the benefit, David, of having 40 years of experience.
Absolutely.
Right? So, this is, 4 decades means something in this business because the asset class itself is only about 40 years old. What we are seeing clearly is an increasing trend towards democratization of private equity as an asset class. And I use the word democratization not just to indicate the fact that there is more high net worth, family office, mass affluent money coming into the asset class, but I also refer to it because it has become a fundamental intrinsic part of the overall portfolio allocation for most investors. And one of the primary reasons driving that trend, actually 2 primary forces driving that trend. One is people have come to appreciate the benefits of generating the associated long-term risk-adjusted return. Right. There is a proven alpha now over public equities. Absolutely. That private equity has been able to capture quite consistently at the median level. So we are not talking about just the top performers at the median level. So there is that premium that has demonstrably been captured over many, many years. The second equally important force is the availability and the development of the secondary markets. Absolutely. For a long period of time, private equity, many people thought the alpha was really the liquidity premium that was embedded in the asset class. So you lock up your money for 5 years, 7 years, sometimes even longer, and you can't get it out, right? And that spooked many investors because the illusion of liquidity was precious to them. But the development of the secondary markets has been a real game changer in the space, not because they offer an alternative to value monetization at the underlying level, but because they are a fantastic channel for providing that liquidity should it be needed by retail investors or institutional investors for unexpected reasons or simple things like rebalancing your portfolio. Right. And that, I think, is really a sign of the maturation and seasoning of the underlying asset class. And I think that's very visible, certainly in this part of the world. I think, candidly speaking, the Gulf has actually led the way, led the rest of the world in terms of democratization of private equity as an asset class. But now you see that increasingly be the case in US, in Europe, and in Asia. Yes. So even in the Asian, somewhat more emerging markets like India, for instance, there is a very tangible, sense of greater adoption of private equity as a mainstream asset class.
We might get tokenization of private equity,
Correct.
Of course, in due course. It will be. We've got time for 1 or 2 questions. I think probably everyone in the audience is at least managing their own portfolio. Could we have some perhaps questions or 1 or 2 questions for this very expert panel we have? Well, that's
somebody there.
Over there. Is there a microphone we could get over there, please?
gentlemen, and Rishi in particular, would you be able to comment on how you are thinking about alternatives, particularly hedge funds, in your portfolio and asset allocation?
We can't hear you, sir.
I heard hedge funds.
Yeah, sorry. Could you comment on how you're thinking about your allocation to alternatives and hedge funds in this paradigm of inflation and higher interest rates? Thank you.
So first of all, no one size fits all. Actually, we do manage quite a few discretionary mandates for our clients, where effectively our investor is saying to us, here's a allocated sum of capital. You, Investcorp, decide how you want to spread it out across the different asset classes within private markets, including hedge funds as liquid alternatives. And the first question we are asking over there is, what is the expected or targeted risk-adjusted return, which helps us optimize the strategic asset allocation? What is the split between, of those expected returns, what is the split between current yield and long-term capital growth? And what is the liquidity expectation, right? Those are the three parameters that we use to drive our strategic asset allocation. In general, right, what we find is it's roughly 50-50, 50% in capital growth, 50% in yielding. The yielding component, in turn, is split into three buckets at least: real estate, infrastructure, and liquid alts. Now, that tends to be somewhere between 10 to 20% each. So think of it as private equity and growth capital being about half of the portfolio, private credit, real estate, and liquid alts being the other half of the portfolio. Liquid alts being hedge funds.
Thank you, Rishi. One more question? No, I see time is flashing up anyway. Thank you. Thank you very much indeed, gentlemen. It's been a most interesting discussion. Big hand for our panel.